Welcome to the Killik & Co podcast for the 7th of May. Shortened week, but no shortage of action expected. Plenty of corporate results to continue to keep that early morning session busy with the analysis. We'll talk about HSBC numbers, which have come out just in the last half an hour or so, but overall the numbers there look pretty good. But a quick look at the diary for what we can expect over the course of the next few days. We'll be focusing on those companies in particular that are highlighted in black, where we can see some covered research. Intercontinental Hotels being one of our preferred stocks for the global macro themes, particularly playing into the Chinese markets there. Intercontinental have strengthened their balance sheet recently with one of the final disposals of the London Park Lane Hotel. So Standard Chartered following on from HSBC, Tullow Oil also. The oil stocks generally being sort of weaker. We'll talk a little bit about the CRB index, the commodity-based index, and where oil prices have been coming off quite recently. In terms of macro stuff, we obviously heard from the ECB last week. They cut their interest rates as expected. They moved them down to 50 basis points from 75 basis points, with that important after comment that they remain ready to move again should the data prove to be deteriorating. Talking of data, with French industrial data that came out this morning showed that manufacturing in France was down 0.9%. That was much worse than expected. But in this environment, much worse numbers imply that possibly central banks will continue to become more benevolent, and as a result of that, stock prices are continuing to rally. So this week it will be the Bank of England. Since the last comment of QE, actually the data from the UK has been a little bit better. Indeed, today we saw new car sales running up around 14% higher than the period of last year. So indications that the UK is performing in certain areas a little bit better than Europe at the moment. So let's take a look. I want to start with one of the sort of key themes for the moment, and that is what's happening to global 10-year bonds for different areas of the market. We're going to take a look at the US first of all. We've seen a little pop up in yields there. This is the yield chart, which stretches over about a year now, and you can see that sort of decline that we've seen. There was a pop up last week with the non-farm payroll data, but really these yields are moving lower as sort of in general. Probably that trend is more notable in the German 10-year, which dipped below 1.2%, has a little pop up, but really again trends are lower. But again, if I can add in the UK, where we're seeing the yields move down from 2.2 to 1.7, and finally from Spain, which has continued to come off those sort of crisis highs, 7.5 down to 4%. Now, what I think is clearly happening here is this, whilst the financial dramas and risks of sovereign default have moved away for some time, it does highlight to me what investors are prepared to pay, in effect, to lock into yields. This feels to me less of a worry about an inflationary environment going forward and a strong economic recovery with inflation and with possibly interest rates turning up in the foreseeable future. It's got the hallmarks for me of continued QE programs to support and stabilise economies, but without inflationary side effects. In that result, it does start to map out, in my mind, maybe a 5-year time horizon where economies are expected to flatline at best. And therefore, in that environment, investors are prepared to pay a higher price to almost accept a lower rate of return, because they think in time that will prove to be a good trade. Other factors which are demonstrating that economies are facing headwinds at the moment continues to be, say, the commodity index, where commodity prices have continued to remain under some pressure from the period of September last year. This CRB index really covers all commodities and oil as well, but you can see the trends are lower there at the moment. So not indicative of what I would say is a market that expects QE programs to stimulate strong economic growth going forward. So in that environment, it's fair to say that we are getting some emerging trends that are taking place. First of all, the euro at the moment is stabilising somewhat against the dollar, but what we are finding is that the equity markets are beginning to put on quite a strong performance. Nowhere better than in Japan. This is the chart of the Nikkei high, which really is probably the most extreme example of what I've been talking about, where QE programs are being thrown at an economy that is faltering, and what is that doing to relative yields that are available into the equity market. We've seen a 37% appreciation here on the Nikkei since January, and that compares to maybe 10% that is being seen in the FTSE 100 at the moment. So really strong outperformance in the Japanese market that is continuing. The US market less weighted obviously to some of those commodity stocks which are suffering somewhat headwinds of commodity pricing. The S&P index is performing more strongly, and this chart is actually a longer dated chart over 10 years, really to highlight the sort of pre-crisis area of the S&P. Obviously there's a very sharp drop that appeared around the Lehman's period, but this recovery has now taken the S&P into new high territory of around 16, 17 on the S&P index at the moment. So US markets have now found their way through to all-time highs. That is true in the DAX as well. The German market has hit an intraday high. London still holding back a little bit, but I expect this re-rating in London to continue. And it is being driven by the equivalent yields that are being found in other asset classes at the moment. The retained accommodative policies by central banks, which I think will keep yields low in those markets, meaning that the earnings yields available from business will become more attractive on a relative basis. And I think that is what is going to drive equity prices higher over the course of the summer months. Finally, this is just a couple of charts here. The FTSE 100, this is a shorter dated chart, 2012, showing that we're on a year high in the FTSE 100, a little bit further to go, probably another 500 points or so to break through, so that we would see all-time highs. A couple of stocks to mention. The first one is Imagination Technologies, which we have recommended within Killik & Co. And we had a profit warning on Friday. The shares did take a nasty thump lower on the profit warning, driven by licences that have failed to materialise before the year end. We expect we're going to see more detail about the timing of those licences, whether they will be re-signed or not, coming through in sort of early part of June when the company reports its full year results. So we'll keep our rating under review until June. And finally, this is the chart of HSBC, just to say that the stock trading strongly today, up 20.734 at the time of this podcast, and the numbers that they demonstrated, it's not about top line growth, it's about maintaining the cost of their business. They have managed to take about 10% off the cost base of HSBC. It's meant that profits are coming through quite strongly. Really, HSBC has too much equity on its balance sheet to achieve its 12 to 15% return on equity target, and there's a strategy meeting that takes place on the 15th of May, and they may just flesh out a little bit more detail about giving back more to shareholders there, whether it be through higher dividends or through some capital repayments. So HSBC putting on a good show on the back of those results today.